Welcome to The Debate. Today, we are opening up the engine block of the financial world to see how it actually runs. We are dissecting a tension that sits right at the heart of every major economy. Yet, well, it remains completely invisible to the average person.
Mm-hmm.
It is the friction between maximizing efficiency, squeezing every drop of return out of capital, and the absolute necessity of preventing catastrophic failure. We are asking a simple but maybe dangerous question. Is insurance just a boring safety net, or is it actually a mechanism for aggressive capital leverage?
And I think that framing, that whole boring safety net idea, is exactly where the misconception lies. I come at it from a different way. Most people treat insurance as a grudge purchase. You pay the premium, you file the policy in a drawer, and you just hope you never need it. But looking at the source material today, specifically the actuarial work by Russell Bingham at the Casualty Actuarial Society, and the deep dive data from the Chubb and Wharton study, it becomes clear that this view is mathematically wrong. We aren't talking about paying claims. We are talking about optimizing a total balance sheet. This is financial engineering, plain and simple.
Precisely. And to ground this high-level math in reality, we are framing this discussion through the lens of Muneris Financial Services. We've chosen this lens because the source material explicitly warns against the danger of disjointed financial strategies, where the left hand doesn't really know the risk the right hand is taking. Muneris represents a pretty unique value proposition because they don't silo these concepts. Their team includes licensed mortgage and real estate brokers who offer comprehensive guidance throughout the transaction, not just at the tail end.
Yeah, that is the critical distinction. You have the firm's CEO, Mansour, who is a qualified life insurance broker, but he's operating alongside lending and real estate experts. So instead of having a mortgage broker pushing debt in one room to maximize your leverage, and then an insurance agent pushing premiums in another to maximize your safety.
Right, completely disconnected.
Exactly.
Instead of that, you have a single trusted source. They can see the interplay, the covariance, which we will get to later, between your assets and your liabilities. It's an integrated approach to exactly what we're about to discuss.
And for our listeners who want to explore this integrated approach for their own balance sheets, you can reach the team directly at 778-898-3202, email mansour@muneris.com, or just visit muneris.com. Now, let's get to the sides. I will be representing the efficiency and return perspective. My argument, based on the Bingham paper, is that insurance companies and, by extension, sophisticated investors must focus on operating return. We should use leverage to create value. High net worth individuals should view insurance strictly as a tool to free up capital for higher returns elsewhere.
And I will be representing the solvency and protection perspective. I'm sorry, but I just don't buy that the primary goal of risk management should be efficiency. The primary goal is preventing ruin. The true value of insurance is removing tail risk, those catastrophic events that absolutely destroy you, to stabilize the portfolio. You don't use a safety belt to drive faster, you use it to survive the crash.
Let's begin with the position statements then. I want to start by challenging how the entire industry measures value. The consumer market, and honestly, even many professionals, are obsessed with return on premium. They ask, I paid $10,000 in premiums, what did I get back? That is a sales number. It tells you absolutely nothing about the efficiency of the capital employed.
Well, it might be a sales number, but it's the number the client actually writes a check for. It feels very real to them.
It feels real, sure, but it's mathematically irrelevant to wealth creation. Drawing directly from the Bingham paper, the true measure of value is operating return. This is the return on the underwriting profit plus the investment income generated on the float.
For the audience, let's clarify float. You mean the money the insurance company holds between receiving premiums and paying out claims, right?
Exactly. Bingham proves that an insurance company is essentially an investment vehicle that rents its balance sheet. By using leverage, specifically the ratio of liabilities to surplus, a company can magnify returns for shareholders. As long as the probability of surplus drawdown is managed, you should push for maximum efficiency. If you are sitting on too much surplus or safety cash, you are dragging down your return on equity. You are just being lazy with your capital.
Lazy or prudent? You talk about magnifying returns via leverage, but the math works both ways. Leverage also magnifies volatility. You are looking at the middle of the distribution, the standard deviation, the things that happen 95% of the time. But policyholders, regulators, and families care about the tail. They care about the extreme events.
But you can price for the tail.
Can you? The Chubb and Wharton study makes it very clear that for the end user, specifically high net worth individuals, the goal isn't just raw return. It is risk-adjusted return. If you chase efficiency too hard, you end up underinsured. The data shows that underinsured portfolios are actually less efficient. They have a lower Sharpe ratio because they are exposed to catastrophic liability loss. You might save a few dollars on premiums to increase your operating return, but one lawsuit or one natural disaster wipes out 20 years of those gains. That isn't efficiency, that's gambling.
I see where you are going, but you are conflating risk with ruin. And this brings us to our first core topic, the metrics of risk, ruin versus drawdown. You mentioned tail risk and the fear of catastrophe. The traditional actuarial model is completely obsessed with the probability of ruin, essentially the chance the company goes completely bankrupt. Bingham argues, and I have to agree, that ruin is too extreme and too rare to be a useful tool for pricing day-to-day risk.
Too rare? Try telling that to anyone who lived through the 2008 financial crisis, or a homeowner in a hurricane zone. Ruin feels pretty relevant to them.
But we aren't talking about the systemic collapse of the global economy. We are talking about pricing a specific product or portfolio. Bingham suggests shifting the focus to the probability of surplus drawdown, or PSD. This measures the likelihood that returns simply fall below a target. It's a much more sensitive, practical metric.
Sensitive is one word for it. I'd call it overly optimistic.
No, it's highly practical. It aligns shareholders' need for consistency with the policyholders' need for safety. If I price my risk based on avoiding a drawdown, a dip in profits, I am naturally building in a buffer that prevents ruin. It creates a unified framework where solvency is ensured by adequate pricing, not just by hoarding cash in a vault like a Scrooge.
See, I come at it from a different way. Drawdown sounds like a bad quarter. Drawdown sounds like the CEO doesn't get his bonus. Ruin means the policyholder doesn't get paid to rebuild their home. Bingham even admits in the source material that highly skewed loss distributions, things like natural catastrophes or massive liability verdicts, can cause massive deficits, even if the probability looks low on a spreadsheet. When you shift the focus to POD, you are essentially telling the policyholder, don't worry, we've calculated that we probably won't lose too much money this year. That is cold comfort when the tail event actually hits. You cannot mathematically define away the risk of total loss just to make the shareholders feel better about their return on equity.
You are painting me as reckless, but you're ignoring the mechanism of pricing. Bingham's model demonstrates that if you set the operating return correctly, factoring in the volatility of the underwriting, you generate a fair premium. That fair premium acts as the first line of defense. The surplus is just the second line. By optimizing the first, you protect the second. It's not about ignoring ruin, it's about preventing it through superior financial engineering rather than brute force capital accumulation.
But that superior engineering relies entirely on leverage. And that leads us to the second topic. Bingham's formula for total return is explicit. It's a formula that every serious investor should know. Total return equals operating return times leverage, plus investment return on surplus. You seem to love this formula because it proves insurance is an investment activity.
It is an investment activity. Look at the formula. The leverage term, liabilities over surplus, is a multiplier. If I can safely run a higher leverage ratio, meaning I write more business relative to my equity, every dollar of operating profit is multiplied. That is how you create wealth. Warren Buffett built Berkshire Hathaway on this exact principle, using insurance float. He used the premium money, which wasn't his, to invest and generate returns before the claims came due.
And that is exactly where the danger lies for the average player who isn't Warren Buffett. Look at the other variable in that equation, or investment return. Bingham points out that if an insurer or an individual managing their own wealth for that matter tries to boost that variable by chasing high investment yields, they introduce mismatching risks.
Explain what you mean by mismatching for the audience.
But that's a choice. You don't have to buy junk bonds.
You can keep the investment side completely conservative and still use leverage on the operating side.
But if you want to maintain that high total return you love so much, you might feel pressured to. And here is the kicker from the source material. Bingham finds that if you increase investment risk, you must charge a higher premium to the policyholder to offset that volatility. You can't just take risks for free. If you are leveraging a volatile asset base, the cost of that risk transfer has to go up. So the efficiency you claim to create is just eaten up by the cost of the risk.
That's an interesting point, though I would frame it differently. Bingham actually argues that you can isolate the investment risk. You can price the policy based on a risk-free rate, and then if the shareholders want to take investment risk, that's on them. It decouples the underwriting from the investing. But let's pivot this to the consumer, because the math is exactly the same. The Chubb and Morton study looks at this total return equation from the perspective of a high net worth individual.
This is a crucial pivot, because wealthy clients often think exactly like the efficiency model you are promoting. They think, I have $30 million. I can self-insure. Why pay premiums? That's inefficient.
It's a completely rational thought. Why rent protection when you own the capital? If I have $30 million, I can absorb a $5 million loss. Why should I pay Chubb or anyone else to hold that risk for me?
Can you absorb it, though? Because the data proves that thinking is wrong. The Wharton researchers tested this hypothesis. They looked at a total balance sheet, or TBS, of $30 million. They compared a portfolio that was underinsured, meaning they saved the premium money but kept the liability risk, versus one that was optimally insured. The optimally insured portfolio had a Sharpe ratio of 0.29, compared to 0.27 for the underinsured one.
And for the listeners, the Sharpe ratio is basically your return per unit of risk. A higher number is better. And I admit, the data there is compelling. The concept they use is left tail risk, the liability lawsuit, the massive property loss.
Exactly. It has a correlation of negative 100% with your wealth. When it hits, it destroys capital instantly.
But here is why that supports my argument for efficiency, ironically. The study showed that the cost to remove that risk to buy the liability umbrella asset was roughly 34 basis points. On a $30 million portfolio, that's about $84,000. By paying that small inefficiency the premium, the investor effectively decapitates the risk distribution. They remove the left tail entirely.
You are calling it an inefficiency, but I call it a foundational asset. You are buying certainty.
Wait, let me finish the thought. By removing that left tail, what does the investor get to do? The study says it explicitly. They can adopt riskier asset allocations in the rest of their portfolio because they aren't terrified of losing $5 million in a random lawsuit. They can shift money from bonds to hedge funds or private equity. The insurance allows for bolder, more efficient investing elsewhere. It validates the idea that risk transfer is a tool for total return.
I'm sorry, but I just don't buy that it's purely about the math of allocation. You are glossing over the psychological aspect mentioned in the source. They talk about the cost of time, effort, and psychological pain. If you are self-insuring or underinsuring just to save money, every time a delivery truck pulls into your driveway, you are assessing liability risk. Every time you host a party, you are worrying about a slip and fall. That psychological drag prevents you from making clear-headed investment decisions. It's not just about bolder investing, it's about the freedom to focus.
I don't disagree with the psychological benefit, but we are debating the financial mechanics here. The opportunity cost argument is the strongest one. If I have to keep $5 million in liquid, low-yield assets just in case I get sued, that is $5 million not earning 8 or 10% in the broader market. The cost of the insurance is negligible compared to the lost yield on that trapped capital. Therefore, insurance creates liquidity. It releases the capital you would otherwise have to hold as a hostage to fortune.
But only if the insurance is structured correctly. And this brings us to the complexity of the problem. We are tossing around Sharpe ratios, PSD, correlation coefficients, and covariance. The Bingham paper explicitly warns against unnecessary confusion in rate-making models. If you are an individual trying to navigate this, or even a business owner, the math is incredibly complex. You can't just guess at your operating return.
That is a very fair critique. The complexity is high, but this validates the Munera's financial services model we discussed at the top of the show. The source material, both Bingham and Chubb, proves that investment, real estate, and insurance are mathematically linked. They have covariance.
Right. Covariance just means they move together. If real estate markets crash, your liquidity dries up just as your liability risk might be spiking.
Exactly. So having a CEO like Mansour who understands the liability side through life insurance and the asset side through mortgages and real estate prevents that disjointed strategy. The Bingham paper warns that if you treat these things separately, if the underwriter doesn't talk to the investment officer, you misprice the risk.
And in the private client world, that translates to the mortgage broker not talking to the insurance agent. You end up with a client who is highly leveraged on real estate, a high liabilities to surplus ratio, to use Bingham's term, but has absolutely no protection against the surplus drawdown of a lawsuit. That is a fragile balance sheet. You are essentially running a hedge fund with no hedge.
You are. And that's why the integration is the efficiency play. If you understand the leverage on the real estate, you can precisely calibrate the insurance to cover the gap. You don't overinsure, which wastes capital, and you don't underinsure, which risks ruin. You optimize.
I will agree that optimization is the goal, but I worry that optimization often leads to complacency. We saw in the Bingham paper that models rely heavily on assumptions, normal distributions, expected values, but the world is not normally distributed. The total balance sheet approach is superior, I agree, but only if it respects the tail. The Chubb study showed that even the optimally insured portfolio didn't hedge 100% of the risk. It hedged about 80 to 90%. There is always residual risk.
But that's the nature of business. Risk cannot be eliminated, as Bingham writes. It must be transferred and priced. The debate isn't about zero risk. It's about the price of the transfer. If you can transfer a catastrophic risk for 34 basis points, that is a trade you take every single day of the week.
True, but the price of the transfer isn't just the premium. It's the vigilance required to maintain the strategy. It requires constant reevaluation of that operating return.
Let's move to our conclusions, because I think we have highlighted a fundamental divergence in philosophy that actually arrives at a similar mathematical truth.
We have.
From my perspective, the efficiency and return side, the evidence is clear. Insurance is not a passive defensive measure. It is an active financial instrument. Whether you are a shareholder analyzing an insurance company using Bingham's operating return model or a high net worth individual looking at the Chubb data, the conclusion is the same. Transferring risk allows you to increase leverage and optimize asset allocation. If you hoard surplus just to avoid drawdown, you are destroying value. You should pay the 34 basis points, transfer the risk, and aggressively compound your capital.
And from the protection and solvency side, I look at the exact same data and see a warning. The warning is that efficiency without a safety margin is just leverage in disguise. The Chubb study proved that underinsured is a bad strategy, not just because it creates less return, but because it introduces unacceptable volatility. The probability of ruin might be statistically low, but its impact is infinite. The value of insurance isn't that it lets you gamble more, it's that it ensures you stay in the game long enough to actually win.
It seems we both agree on this synthesis, which is the Bingham principle. Risk must be priced. If you don't pay the price to an insurer, you are paying the price in trapped capital or volatility on your own balance sheet.
Absolutely. There is no such thing as free risk retention. You pay for it one way or another.
And to implement these sophisticated total balance sheet strategies, you cannot rely on siloed advice. You need a team that understands the covariance between your assets and your liabilities.
Agreed. You need someone who can do the math on both sides of the ledger.
For our listeners who want to align their liability protection with their investment goals, we highly recommend contacting the team at Munera's Financial Services. You can reach them at 778-898-3202 or at muneras.com. They have the expertise to navigate this complex financial engineering.
It was a pleasure dissecting the numbers with you today.
Likewise, thank you for joining us for this intellectual exchange. Welcome to the debate, and we hope you leave with a clear perspective on your own portfolio.